Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you so much for joining us today for our Executive Benefit Planning webinar. For those of you joining us for the first time today, my name is Amanda Murray, and I am the Client Service Associate for Stonehearth Capital Management. I've been with Stonehearth for about 2.5 years, working on marketing and compliance, as well as assisting our advisors administratively. I just wanted to go over a few line items before we get started. On your taskbar, you should see a section for questions. Please submit your questions at any time during the webinar. I will be monitoring all of them and will relay them over to David during the questions portion of the presentation. This presentation is being recorded and will be available for viewing on our website at www.stonehearthcapital.com later this afternoon. Also, a corresponding white paper on executive benefits is also currently available on our website under the Resources tab on the homepage. I'd now like to introduce our speaker for today, David Juliano. David is a senior financial advisor for Stonehearth Capital Management and joined the firm back in 2016. He has over 20 years of experience in financial planning and wealth management, and has previously worked for an advisory practice that specialized in executive benefit solutions and deferred compensation plans for executives at banks and hospitals before moving on to Commonwealth Financial Network and later joining our team here at Stonehearth. I'm excited to hear from him today, as I'm sure all of you are, so I'm happy to pass this presentation over to David so he can share some of his expertise on the topic of executive benefit planning. David?
Thank you very much, Amanda, and welcome to everybody. Thank you for joining us today. We are going to discuss executive benefit planning, and we have a lot of great information to get to today, so I'm going to jump right into it. What we're going to talk about today is really to set the stage on talking about deferred compensation plans and other non-qualified plans. I want to talk a little bit about the differences between those plans and the other plans that are more commonly known, such as qualified plans like 401ks and so forth. So we're going to talk about the differences between qualified plans and non-qualified plans, which are the type that we'll be mostly talking about today. And we'll get into why these executive benefit plans are used. And then we'll discuss the two main types of these executive benefit plans, which would generally be categorized into non-equity based executive benefit plans, such as deferred compensation and other insurance-based plans. And then the other major category of these types of plans are equity-based executive benefit plans, such as stock options and other plans that are based on company stock. So we also want to get into a little bit about the tax treatment of all of these plan types. And then we'll spend a little bit of time at the end discussing financial planning considerations with all of these types of plans. So you'll have a better understanding of really how do these plans work within your overall financial plan and with the ability to help you achieve all of your financial goals. So first, as I said, we're going to set the stage by talking about the differences between qualified plans and non-qualified plans. So as many of you know, with a qualified plan, the investment income accumulates tax-free under the plan, and the folks who are in the plan aren't taxed until they receive any distributions from the plan. And of course, with a tax-free rollover, you can postpone taxation even further. So that's the way qualified plans work, such as 403Bs, 401ks, and so forth. But however, there's a price for this favorable tax treatment, and it's complying with a lot of tax qualification rules. So qualified plans are governed by strict ERISA rules. They can't really be offered to just a select group of employees. They need to be offered to all employees. And also, they need to be, they also need to work in such a way where they have, hold on a minute, I think everybody may not be seeing my screen here. Okay, sorry about that. And the other thing is that there are limits on salary deferral amounts that can work with these types of plans, and they can't always be designed to just favor highly compensated employees. So when we talk about the reasons for using non-qualified plans, they're in situations where companies want to just benefit their highly compensated or senior level employees. So the nice benefit for non-qualified plans are that they're not governed by those restrictive tax rules, and they actually have to be offered to just a select group of highly compensated employees or key employees, and as such, these plans are referred to as top hat plans. So a top hat plan is an unfunded plan that has to be maintained for a select group of management or highly compensated employees, and these plans also offer higher contribution limits, which really allow for additional salary deferral by some of the highly compensated folks who may have already maxed out their contributions to their 401ks or other qualified plans. And these non-qualified plans also offer greater plan design flexibility. And why companies like to use these is they can customize plans for each executive in the plan. So these types of executive benefit plans don't have to be the same for each person who's in the plan. So really, why are they used? Well, for many of the reasons that I just talked about, and also these plans are most widely used because they can offer an additional benefit that an employer can provide for some of their highly compensated employees without having to include the rest of the employee population or all of the rank and file employees. And second, it really can be used to attract and reward key employees and other highly paid executives by providing them extra benefits beyond that which can be done in a qualified plan. And third, it really is used commonly to retain top employees by using what's commonly called golden handcuffs on these special extra benefits, where the employee must stay with the employer for a long time in order to receive benefits from these plans. So previously, before there were some rules set in place, before 2004, non-qualified plans were relatively unregulated in comparison to qualified plans. And starting in 2005, however, non-qualified plans started to have to comply with the rules set forth under Code Section 409A. And really, in that sense, that code section restricts an employee's initial election to defer receiving compensation, and also it set forth rules for the employee's subsequent election of further deferring the receipt of the compensation or their ability to accelerate the receipt of compensation. So really what Section 409A did is put a playbook or a set of rules around these deferred compensation plans. And as I move through the next few slides to talk about those plans, I'll talk about those rules in further detail. So in looking at the first major category of these executive benefit plans, we'll talk about the non-equity based executive benefit plans. And those comprise of the major categories that we see here. So we've got non-qualified deferred compensation plans, which are broken into either a traditional deferred compensation plan or a supplemental executive retirement plan. And then we also have executive bonus arrangements, death benefit only plans, and split dollar life insurance plans. And I'll go over a little bit into each one of those. So with non-qualified deferred compensation plans, they can be really designed in a variety of ways, which is why employers like to use them. The two primary types are a traditional deferred compensation plan, which many of you may already know of or have been offered one of these types of plans in the past, and also a supplemental executive retirement plan, or what's commonly referred to as a SERP. So let's start by talking about the traditional deferred compensation plans. As I mentioned, the rules allow for a wide variety of ways that you can design a plan, but the typical design allows for a participant who would be a senior executive or a highly compensated employee to defer a portion, even up to 100% of their base salary, as well as up to 100% of bonus pay. So when you think about that for a second, as we were comparing the differences between these plans and qualified plans such as 401ks and so forth have deferral limits. So you can only put in 18,500 or maybe up to 24,000 if you're over 50 years old. So there's all those qualified plan limits that limit the amount that you can set aside from your compensation to receive in the future. With these types of plans, the rules actually allow for you to defer up to 100% of your compensation, although many plans restrict that to about 80 or 90% of compensation, just so that there's a little bit of compensation received each pay period by an employee for things like medical insurance deductions and other things like that. The executives in the plan can actually elect to defer a different amount each year as they go through the plan. And the deferral amount, one of the rules is that the amount must be determined in the year prior to the year of earnings. So, for example, if you wanted to defer a portion of your 2018 income, you'd have to do that by the end of 2017. And for performance-based compensation, typically a bonus that's paid based on some measurement, that election to defer that must be made no later than 6 months prior to the end of that performance period. So if someone were to be getting a bonus in 2017 that might be paid out at the end of the year, you'd have to elect to defer that no later than 6 months into the year. And the nice thing about these plans for the employee is that they can provide a lot of flexibility for the receipt of that deferred income. And the only rule there is that the executive must choose when to receive the deferred income at the time of the original deferral. So let's say that by the end of 2017, you elect to defer some of your 2018 income. You may elect to defer, say, 25% of that 2018 income. You can allocate that deferred income into different buckets that you want to receive at different times in the future. For example, maybe you want to put 15% of that deferred income to be received at retirement, and maybe 10% of that to be received when your child is going to school, for example, and you have to pay college tuition. So it provides for a lot of flexibility of not only deferring different amounts of income each year, but also being able to make the election of when you want to receive that deferred income. The key is, though, that once you make that deferral to receive it at a certain time, you're not able to make changes. The rules do allow for penalty-free withdrawals from these non-qualified plans for the following reasons, such as separation from service, disability, death, an actual time specified under the plan, like we were just talking about, retirement, or another economic event that the executive wants to get the income from. And also if there's a change in business ownership and any unforeseeable emergency situation. So those are ways that money can come out of a non-qualified plan. With a traditional deferred compensation plan, these have to be designed to be what's considered unfunded plans under the non-qualified deferred compensation rules in order to enjoy all of the favorable tax benefits. So with an unfunded plan, it's really an unsecured promise by the employee to pay those benefits or by the employer to pay those benefits to the employee in the future. The employer may set aside assets to pay those benefits in the future to back up its obligation to pay the benefits, or it can simply pay the benefits as they come due out of current earnings. And that may be okay for a very large, say, heavily capitalized business, but many large businesses, and probably all smaller ones, can and probably should set aside some funds to have on hand to pay the benefits that are owed to the executives in the future. You know, not many people would want to take the chance to defer income just merely on a promise to pay by their employer to pay those benefits out in the future. If a company does set aside funds to cover the benefits through insurance or otherwise, the employees have no rights or interest in those funds. They have to be simply employer-owned funds that are subject to the company's creditors. So the key is that when you elect to make a deferral of your compensation under these plans, the employer now withholds compensation that they otherwise would have paid to you, but then that compensation just becomes a general asset of the corporation subject to corporate creditors. So these unfunded plans provide the desired tax deferral that many people want when they set aside this deferred compensation. However, those deferred assets are subject to creditor risk. So even if the employer decides to set aside funds to pay these future obligations, they have to just be general assets of the company. They can't have an individual account for every executive who has elected to defer compensation. Now, a plan may be unfunded by the tax rules, which is to say that the company has not set aside specific assets for each person in the plan, but the company can choose to finance a plan, which means that the company has said, well, we have this obligation to pay out all of these future benefits of the deferred compensation. So why don't we set assets aside that will be earmarked to be used for that purpose? And if they set it aside, it just has to be held generally, as I said, as an asset of the corporation, not in individual accounts for each person that's in the plan. So there are various ways that companies can do this, that they can finance a plan. They can just have a reserve account that's maintained by the employer. That could just be a brokerage account that's maintained by the employer. It could just simply be cash on hand that they retain to meet those future obligations. Companies could use corporate-owned life insurance to hold these assets, which a lot of companies do because then they would get the tax deferral on the growth of those assets. Companies can also use what's called a rabbi trust, which such trusts got their name because it was a rabbi who first received a blessing from the IRS to receive favorable tax treatment for the use of this type of trust. Really what that means is if a company decides to hold assets in a rabbi trust to pay future deferred comp obligations, those assets are still subject to corporate creditors, but it puts what some people call like a half of a brick wall around the assets because it's saying that the company can't use these assets to fund another initiative of the company. These assets have to be used to pay out future obligations of the deferred compensation plan. So the rabbi trust provides a little security for the employee to know, well, my deferred income is still subject to corporate creditors, but at least they've set it aside in this trust, and it gives the company a better chance of having those assets be there in the future when they're owed to the employees. So the tax treatment that's desired with these types of unfunded deferred compensation plan is that the executive doesn't pay taxes when the money is earned and deferred. Rather, income taxes are due when the income is later received, and any deferred income payable at death would be taxable to the beneficiaries of the executive in the plan. So if the executive, for example, were receiving a 10-year payout from a deferred compensation plan and they died in year 5 into retirement, there were 5 more years left to pay out on that plan. The beneficiaries of that executive are entitled to receive those payments, but they would be taxable to the beneficiaries just as they were to be taxable to the employee when they were getting them while living. So with the idea of these unfunded plans, you're able to achieve the desired tax deferral. If a plan were funded, which would mean that assets were specifically set aside in an account for each executive that was in the plan, then the deferred income would be taxable when it's vested, even though it may not be actually receive. So you don't really see any funded deferred compensation plans. You'll usually see them unfunded, but the company may, as I said, finance the obligation with some corporate-owned asset. And now that we've fairly well covered the tax and technical and funding aspects of non-qualified deferred compensation plans, you can see the potential prospects for these plans are mainly larger, stable, multi-owner C corporations because of the separate tax brackets of the corporation and the employee. So if I'm an employee and I'm earning money and I want to defer it, now that deferred income is being held by the corporation. Myself as an individual, I'm a separate tax-paying entity from the corporation, so I can essentially push that income back to the corporation and let them worry about paying taxes on it or putting it into some tax-deferred vehicle of their choice. So as a result, deferred compensation plans really don't make sense for S corporation stockholders or partners in a partnership or members of a limited liability company, because there's no way to get any deferred compensation because the owners pay tax on all the earnings directly held by the company. And also deferred compensation may not really make sense where the corporation won't survive after the death of a sole owner of a business. So in other words, you may have a sole owner C corporation. And as I said, C corporations are better suited for these plans, but if it's a sole owner C corporation and the corporation is not likely to survive that owner, then there really isn't a viable entity there to continue to pay the deferred compensation out. So these plans are really best suited in the larger C corporations. So getting to the second type of these non-qualified deferred compensation plans is a supplemental executive retirement plan, or what's commonly referred to as a SERP. So with a SERP, it's just another type of deferred comp plan, as I mentioned, and they're really guided by the same rules as the traditional deferred comp plans, as I mentioned, Section 409A rules, but they can be structured either as a defined contribution or a defined benefit plan. So really, they're typically designed to supplement an employer's qualified plan benefits, and usually there's no executive salary deferral component to a SERP. It's just more set up to have the employer agree to provide future benefits from the employee's assets. So in a traditional deferred comp plan, that would feature the employee deciding to defer some of their currently earned compensation for them to receive it in the future. With a SERP, the employee is generally going to continue to receive their full compensation, but over and above that, the employer has agreed to pay some additional compensation to them in the future at a predetermined date, normally retirement. So a SERP is similar to a traditional deferred compensation plan in that it's an unsecured promise by the employer to pay a future benefit to the executive. It's typically unfunded and offered to a top hat group, so the same as the traditional deferred comp plan. It's considered a top hat plan. So again, you're intentionally discriminating with these plans and only offering them to a select group of your top employees. And if it is unfunded, then the executive doesn't pay any income tax until the benefits are paid out in the future. And also, as we mentioned with traditional deferred comp plans, these SERPs can be financed by the employer by just earmarking assets to pay future benefits. And just as a quick review, the same with the deferred comp plans, those earmarked assets are subject to corporate creditors. They can use a rabbi trust or life insurance to hold the earmarked assets, and the assets are not guaranteed to be paid to the executive. So basically, here's how a SERP works. You've got an employer who agrees to contribute money to usually a golden handcuff plan, a type of plan that retains the executive. The employee's golden handcuff account is subject to a vesting schedule determined by the employer. So typically the employer would say, you can receive these benefits upon some type of vesting, usually retirement or so many years of service. and the employer then gets a tax deduction when these benefits are paid out to the employee, and the employer can really decide whether they want to set this up as either a defined contribution plan where they say we're going to put away so much money per year until you are vested and then we'll pay this out, or it may be structured more as a defined benefit plan where the employer can say upon your retirement date we'll pay you X amount per year for so many years at your retirement. So it's really a future benefit promised by the employer. So those are really the types of deferred compensation plans that you would typically see, either the traditional deferred comp or the ChRP. Now, there are some other insurance-based executive benefit programs that we'll talk a little bit about here. I'm not going to spend too much time on these because we have additional information to get into with stock options and so forth. And I do have additional information on these types of plans in the white paper that is up on our website at stonehearthcapital.com. But we'll get into a little bit about these plans, which are executive bonus arrangements, death benefit only plans, and split dollar life insurance plans. So the first one is an executive bonus or a Section 162 plan. They're named, they're called Section 162 plans often because they're named after the Internal Revenue Code section that governs these plans. And really what these plans are an employer providing a personally owned life insurance as an extra benefit to owners or select key employees. So the employer pays a bonus to the employee. Normally the employer wants to have this set up as a personally owned life insurance policy for the executive in the plan so that the employee gets extra life insurance benefit, but they also are typically invested in a cash value type of life insurance program where as the employer pays the premium into these policies, the employee owns the policy and has the tax-free or tax-deferred buildup of the cash value within these policies. So the employer then chooses which employees it wants to include in the plan and how much of a bonus, which is a premium payment into the insurance policy that it wants to provide to each employee. Subsequently, each employee that's part of the plan, they'll apply for and own a life insurance policy on their life, and they get to name a personal beneficiary. So the business pays the premiums. Usually the business pays the premiums directly to the life insurance policy, and they report that amount to the employee as extra compensation. So there's no real tax deferral of this bonus to the employee like we saw with the traditional deferred comp plans or ChRPs. When the employer pays that bonus as a premium payment into the life insurance policy, the executive is taxed on that as income. The bonus payment goes into the life insurance policy in the form of a premium, and then you start to build up cash value in this life insurance policy with the goal of that cash value accumulating tax deferred and being available to provide some extra retirement income by withdrawing off of that cash value in the future. And secondarily, the executive also has that death benefit component there to provide some death benefit protection to their heirs that they select. As long as the total compensation is reasonable to the employee, then the premiums paid are tax deductible to the business. As I mentioned, the employee reports this as taxable income. And the real benefit here is that the cash value growth in the life insurance is tax deferred. So briefly, this is how an executive bonus arrangement works. The employer pays a taxable bonus to the employee. The employee is the policy owner. The premium payments are made to the insurance company, either by the employee or directly by the employer. And then eventually, the retirement benefits come back to the employee in the form of withdrawals or loans from the cash value of the life insurance contract. The second type of these plans is called the death benefit only plan. This would be a situation where an employer elects to pay employee compensation to a designated beneficiary at the employee death. So there's no actual payment to the employee during their lifetime. As the name suggests, it's a death benefit only plan. So the idea is that the executive has some comfort in the fact that a death benefit will be paid out to their beneficiaries upon their death, and that payment will come from the employer. So there's various design options, but usually they're set up so that it's either a fixed dollar amount that's paid out to the beneficiaries of the employee, or it's, say, an average compensation over a period of time. So they may look at the executive's highest 3 or highest 5-year compensation and take an average of that and agree to pay that out over time after the death of the employee. The tax implications are such that the death benefit would not be included in the employee's estate if certain things are done, such that the plan doesn't provide any benefits payable during the employee's lifetime. And also, if the employee does not have the right to change the beneficiary that they've established at the beginning of the plan. So that the benefits that are paid to the employee's beneficiaries are taxable in full to the beneficiary as ordinary income. The third type of benefit that we'll talk about that are not traditional deferred comp plans, but are different types of executive benefits, are split dollar life insurance. With this type of arrangement, it's really a life insurance funding arrangement between two parties, usually between an employer and a senior executive. The plans are designed usually so that the employer and the employee agree to split the premiums and the benefits of the life insurance policy. And the employer would pay usually a portion of the premium to purchase life insurance for the executive, and the employer will usually recover its premiums paid through policy benefits. For example, when the executive dies or when they retire, the employer will receive their premiums paid back from the benefits of the policy. The idea is that you're providing an extra life insurance benefit to the executive, and executives' beneficiaries can receive income tax-free death benefits because in most cases the employee will own the policy. So when the employee owns the policy and designates beneficiaries, those beneficiaries receive a tax-free death benefit when that employee passes away, or these benefits can provide additional retirement benefit by having the cash value in these policies be there to supplement the retirement income needs of the employee. These plans really have to be designed under two methods. There's the economic benefit regime or the loan regime. And these plans aren't as widely used as they used to be after rule changes back in 2003. But there still are many arrangements that are out there and active today that were put in place prior to those rule changes. But these plans can have fairly complex tax treatment. And as a result, we would advise folks that if you do have one of these plans that you've been in for a while or that was offered to you a long time ago and you still have an insurance policy active under a split dollar arrangement, we can certainly review those plan documents and offer any guidance on what your options might be. So we've covered all of our non-equity based executive benefit programs. I want to spend the balance of our time here going over different equity-based executive benefit plans. So with the non-equity based executive benefit plans, we saw traditional deferred comp, ChFC, executive bonus plans, death benefit only, and split dollar. So those were all situations where an employer wants to offer some type of deferred compensation or insurance-based benefit program to an executive or key employee for purposes of providing benefits over and above what qualified plans can offer. Another way that companies like to benefit their key employees are offering benefits that are based on the company's stock. So that's where we arrive at these equity-based executive benefit plans. And they fall into a couple of main categories. They would either be restricted stock or restricted stock units, which are RSUs, or they're employee stock options, which there are two categories of stock options: non-qualified stock options and incentive stock options. So we'll talk about all of these. And these are really just programs that issue company stock to executives or allow them to purchase company stock, or they provide additional compensation to the executives based on the value of the company stock. So let's get into the first type, which is restricted stock or RSUs. And this is a type of a senior executive compensation benefit that are oftentimes used alongside of stock options, but they do have very important differences from stock options, and we'll get into that in a few minutes. These are either shares or share units that are granted to the employee, and they're typically subject to a vesting restriction, which is where the restriction title comes from in these types of benefits. So the shares retain some value to the executive, even if the share price declines, which is why executives usually like this type of benefit. And there are some important differences between restricted stock and the RSUs, and we'll spend a few minutes talking about that. But essentially, with the restricted stock plan, the stock is actually transferred to the executive on the grant date. However, with a restricted stock unit plan, it's really just a unit or a bookkeeping entry where the company says we promise to deliver an actual share of stock to you when you vest. So we'll go over these plans and explain how they work. So essentially, there are some similarities between restricted stock and RSUs. And mostly that's in how the plans work. So a restricted stock or a stock unit is granted to the executive. And they're restricted since the executive can't sell or transfer the shares until they're actually vested. And prior to vesting, the executive doesn't fully own the shares or units the same way as they would if they just went out and bought shares of the company stock. The restriction usually lapses upon vesting in the share or unit. So the reason why these are used is companies grant these restricted stock or RSUs to employees to entice the employee to stay for a certain amount of time until they become vested, and then they'll actually have value to the executive. And then at vesting, the executive now actually owns the share outright as if they purchased it on the open market. So the restriction is lifted upon vesting, and now they actually own the share. And as I mentioned, vesting is usually a time-based. So for example, you see a lot of restricted stock or RSU plans where the shares are vested, meaning the restriction is lifted if they're still working at the company, say 3 years after the stock was initially granted. So the standard tax treatment of these plans is such that there's no tax at the grant date. So if my company grants me restricted stock or RSUs, I don't pay any tax when they first grant them to me. The taxable event happens upon the vesting date. And at that point, I'm taxed at ordinary income, and the taxable income is equal to the fair market value of the shares on the vesting date. And that amount also becomes your tax basis per share. So any future gain or loss that you would report would come on the fair market value of the share on that vesting date, and that's what you're taxed on as compensation. So the capital gains holding period begins on that vesting date, and any future gain is taxed at short or long-term gain depending on the normal holding period rules. So let's look at what that would look like in this example. So let's say a company grants 4,000 shares of restricted stock that vests at 25% a year with a grant market price of $18 per share. So whenever a company grants you restricted stock, that stock will just have a share value on the grant date. And let's say a year later, it's $20 per share, and 25% or 1,000 of those shares became vested. So since it's $20 a share, 1,000 shares become vested, meaning the restriction is lifted. That employee now has $20,000 of ordinary income, and they now own 1,000 shares of that company stock at the current price of $20. So they're taxed on that. That becomes their tax basis, and any future gain or loss would be based off of that $20. And then as you can see, year 2, 3, and 4, we have the rest of those shares will vest at 1,000 shares per year. So, and we're assuming that there's different share prices that happen throughout the rest of those years. So in this example, we have shares vest at $20, $25, $30, and $33 per share. So you've got a total tax basis or total ordinary income of $108,000. And each increment is taxable on its vesting date. And if the stock is sold 2 years after the last vesting date, when the price is $50 a share, so let's say we sell all 4,000 of them for $50 a share, that's 200,000. So we'd have a capital gain of 92,000 because our original tax basis was 108. We sold them all for 200,000, so we have a gain of 92. That's basically how the tax and the future gain would work on a restricted stock or a restricted stock unit. Now, as I mentioned, those are all the similarities between the two plans. There are some differences between restricted stock and RSUs, and they can really be summarized here on the different dates. So on the grant date of restricted stock, the actual share of stock is actually granted to the executive. It just has a restriction on it that says you can't actually sell or transfer it. Whereas an RSU, no actual share is granted, just a share unit is granted, which is really just an unfunded promise to issue a share or a cash payment at a later date. So an RSU grant is really just a bookkeeping entry. So some companies may want to use RSUs instead of an actual restricted stock because they don't want to grant stock to the employee until they're actually vested. And then at the vesting date or during the vesting period, that's the restricted period. And with the restricted stock, an executive can actually receive dividends and have voting rights because remember, they've actually been granted the stock. So they own it per se, but because it's restricted, it just means they can't sell or transfer it, but they can still receive dividends and have voting rights. Whereas an RSU, as we mentioned, no actual share is granted. So consequently, you have no dividends and no voting rights, although companies sometimes choose to pay a dividend equivalent to an employee, which is just simply a cash payment that would be equal to a dividend if they actually own the shares. And then at the vesting date, the restricted stock, the restriction is lifted and the executive owns the shares outright. And with an RSU, the actual shares are delivered to the executive if the company wants to structure it that way, or the company may just simply pay a cash bonus to the executive in lieu of delivering actual shares. So companies will decide whether or not they want to use restricted stock or restricted stock units based on what the company would like to do. For instance, if they don't want to dilute ownership of the shares, they might use an RSU and then just simply pay a cash benefit to the executive upon vesting instead of delivering actual shares. There is a way to elect some alternative tax treatment on restricted stock. So you remember I mentioned in our example, we had 4,000 shares granted to the executive with a market price of $18 per share. And as we waited for them to vest, the share price went up. And as the share price goes up, that's what the executive is taxed on. Well, there is alternate tax treatment that someone can use for restricted stock, but it's not available for RSUs. And this tax treatment is referred to as making a Section 83B election with the IRS within 30 days after being granted restricted stock. So why would someone want to do this? Because it would, excuse me, it would represent paying taxes earlier than you have to. So with a restricted stock plan, you normally wouldn't pay taxes until it's actually vested and the restriction is lifted. However, making an 83B election says, I'd like to get taxed immediately when they're granted to me. And the reason why someone might want to do that is because they feel like the stock price is going to go up rapidly, and by the time it vests, then they'll be taxed on a higher value. But there are some risks with making the 83B election, which are very important to be aware of. So if you leave the company prior to vesting, for example, you'll actually forfeit the shares, and you'll never own the shares, but you would have paid taxes on the shares when they were granted to you. And if you forfeit them, you may not actually ever own the shares. Or the stock price could simply decrease before vesting, and you ended up paying taxes on a higher value. So it may have been granted to you at $18 a share. You paid taxes on $18 per share, and then by the time it vested, it was only worth $15 a share, and you would have been taxed on a lower amount had you not made the 83B election. And the other important thing about the 83B election is that you cannot rescind the election or recover the taxes paid. Once you elect to make that 83B election, you've accelerated the taxation of the restricted stock to the grant date, and you cannot recover any of those taxes paid after you make that tax payment election. So let's move over to the two types of stock options. So we covered restricted stock and restricted stock units, which is a first type of our equity-based compensation plan, but those are not stock options. So now we want to go over to stock options, which are another type of equity-based compensation plan. And there's two types of stock options. The first one is a non-qualified stock option. And it's really called a non-qualified stock option because it doesn't qualify for favorable tax treatment, which the next type of option that we'll talk about does. So a non-qualified stock option, or an NSO, is a type of employee stock option that's granted to an executive, and it's really the most common form of employee stock option. And it can be granted to employees, officers, directors, and consultants. So it doesn't always have to be granted to only employees of a corporation. And what an option does is it really provides the right to buy a specific number of shares at a predetermined price at some time in the future. So just as the name suggests, it's a stock option. It's an option to buy the stock at some point in the future. So remember, with restricted stock or a restricted stock unit, you're just going to own that share on the vesting date. You don't have an option to buy it or not. You're just simply going to own it. With a stock option, you're given the option to purchase the stock at a predetermined price at some point in the future. And you usually cannot exercise a stock option until it becomes vested. So usually options are granted, and to entice the executive to stay on board, to have value in these options, they come with a vesting period, which is usually an amount of time that has to go by before they're vested and they can exercise these. Usually if someone terminates a job, it can trigger the accelerated expiration of these options, and they usually come with a expiration period of 10 years, but if someone leaves their employer, they usually have accelerated vesting. And these options really only have value if the exercise price is lower than the current current market price, and we'll go over some examples of how that works. The difference between the exercise price and which is the price that an employee would pay to exercise the option, the difference between that and the market price of the stock option when they exercise is called the spread. So they may be given an option with an exercise price of $10 a share. When they decide to exercise that, the stock is worth $15 a share. They can buy it for $10. It's currently worth $15, so there's a $5 spread there. In this case, the spread is taxed as ordinary income, subject to income tax, Social Security, Medicare taxes, and so forth. Then upon exercise, the shares are owned outright as if they bought it in the open market, and any future gain would be taxed at capital gains rates determined by the holding period, which starts on the date of exercise. So let's look at an example. Let's say an employee gets 100 stock options, and the exercise price is $10 a share. As I said, the current market price is $15 a share. To complete the exercise, they'd have to pay $1,000 to purchase the shares. So you have to, when you have a stock option, you have to actually buy the shares for the exercise price. In this case, it would be $10 times 100 shares. So there'd be a $1,000 exercise price to the employee, and the spread of 500, which is the market value of the shares at the time of exercise over what they paid for it, that spread is an ordinary income item to the executive. Now, there are some other exercise methods that some more advanced stock option programs can offer. So instead of me having to come up with the $1,000 in cash to exercise that, some companies say, well, you can do a stock swap. You may already own company stock from a previous exercise or a vesting of a restricted stock. So you can swap us $1,000 worth of company stock you already own as a method to pay for that exercise. You can also do what's maybe called a cashless exercise, where you immediately sell all of the shares that you exercised right after you exercise the option, so that you don't actually have to come up with the money to buy it. They do an exercise and a sell in one transaction, and then you just receive the cash proceeds from that. You can also do what's called a sell to cover exercise, which is that you're just selling enough shares out of what you exercise to cover the taxes that were triggered by that exercise. And just to review, with non-qualified stock options, the spread at exercise is included as an ordinary income item for the year that the exercise occurred. So again, as an example, the executive exercises 500 options with an exercise price of $15 a share. The market value of the shares on the date of exercise is $20. The executive will have additional ordinary income of $2,500 as a result of exercising the options. Now let's get into our last type of benefit plan that we're going to talk about today, which is the other type of employee stock option. They're called incentive stock options. These are a type of employee stock option that do qualify for special tax treatment. If certain requirements are met, then there's special tax treatment with these. Now, with incentive stock options, they can only be granted to employees, usually executives, so they cannot be granted to any consultants or outside directors like we saw with the non-qualified options. The incentive stock option can be, as a non-qualified option, it can be exercised to buy a certain number of company shares at a set price during a set period, so similar to NSOs, and they typically have a vesting period, and the ISOs can then be exercised after the vesting period is reached. The ISOs also expire at the end of a set term, usually 10 years from grant. And at termination, so if an employee terminates, usually any unvested ISOs are forfeited, but any vested ISOs can still be exercised. Usually they have to be exercised within 3 months after termination from service to retain those favorable tax benefits that I'll talk about in a moment. And upon exercise, the shares are owned in the same manner as any other shareholder. So just like non-qualified stock options, with an incentive stock option, when you exercise it, you now own the share outright. And then that exercise date starts your holding period. And then upon any subsequent sale, the capital gains tax treatment is determined by normal holding period rules. So if you hold it for longer than a year, you would get long-term capital gain treatment. But the real key point with incentive stock options is that if you own the share for 1 year after exercise and 2 years after the grant, then all the gain over the exercise price is long-term capital gain. So remember, with non-qualified stock options, when we exercise them, that spread was taxed at ordinary income. There's no way to change that. However, with incentive stock options, if you exercise them, if you hold them for a year, and it was also 2 years after they were granted, then you get long-term capital gain treatment on all of that spread. So with ISOs, then there's no withholding of Social Security or Medicare tax, even if you sell within 1 year of exercise. But the spread on exercise with ISOs is part of the alternative minimum tax, which we won't get into today, but it's important to be aware of that exercising incentive stock options may trigger the application of the alternative minimum tax. So that's a very important factor to consider with planning with incentive stock options. So let's look at an example of incentive stock option taxation. Let's say that an executive exercises 2,000 options with an exercise price of 15 when the market price is 20. And they're going to pay $30,000 to exercise because it was $15 a share times 2,000 options. So they'll pay $30,000 to exercise. If they hold it for 1 year from exercise or 2 years from the grant, and they sell it at 20, that spread of $10,000 or $5 over the exercise price times 2,000 shares, so $10,000 is now taxed at long-term capital gain instead of ordinary income. So that's the real benefit of incentive stock options. So you've got $1,500 of federal capital gains tax, assuming a 15% tax rate plus state taxes. So a lot better than having that spread be taxed at ordinary income. And as a result, as I mentioned, no Social Security or Medicare tax and no ordinary income tax. Now, an important thing to understand with incentive stock options, if you do sell it within a year of exercise, it's referred to as a disqualifying disposition. And in that case, when shares are acquired through exercising an ISO, if they're sold within a year of exercise or 2 years from grant, then that favorable tax treatment is no longer available. And now the spread at exercise is taxed at ordinary income, so similar to a non-qualified stock option. So if you exercise an ISO and sell it within a year, you lose that favorable tax treatment. Although with ISOs, there's still no withholding, including Social Security or Medicare. It would just be taxed at ordinary income. So the key point is with an incentive stock option, you want to have cash on hand so that when you exercise it, you want to be able to come up with that exercise price because you're going to hold it for a year. Whereas with a non-qualified stock option, you may be able to just immediately sell some of them because you're going to be taxed at ordinary income on the spread anyway. With incentive stock options, you want to do some advanced planning so that you know you're going to be holding these for 1 year so that you can get the more favorable tax treatment. So if you do sell the incentive stock option within a year of exercise, you do lose that favorable tax treatment, but the alternative minimum tax does not apply anymore. So there's a lot of planning considerations to be aware of with restricted stock and RSUs and stock options. So you really want to pay attention to all of the vesting schedules and the expiration dates. I talked a lot today about different dates when things vest and when they expire. So typically when you're granted these types of equity benefit programs, you're getting grants every year, and they may come with various vesting schedules and different expiration dates. So you really want to be aware of them so that you don't lose any options that might expire because you haven't exercised them in time by the expiration date. And you want to be familiar with the terms and features in these equity compensation plan documents. So there's always a plan document that's going to be given to employees when they're part of a plan like this, and the plan documents will have all the details on how the plan works. So you really don't want to ever let any stock option that has value expire because you've lost the value. So we've seen that before, where if someone isn't really in tune with all their expiration dates, the options may expire and they didn't get a chance to exercise them. And you really want to be aware of what's called an overconcentration risk. So a lot of times executives are in these plans and they're getting restricted stock, they're getting non-qualified stock options, they're getting incentive stock options, and you end up with a lot of different options and owning a lot of company stocks. You want to be aware of not owning too much company stock. And you want to be aware of all the different exercise methods that are offered within the plan. I talked about different ways you can do a stock swap, for example. And you want to pay attention to tax planning, so that I talked about the AMT with incentive stock options, and you also want to be aware of the other items related to tax planning. So it's really important to develop a long-term planning with restricted stock and options, and have all of that planning be in conjunction with your financial goals. And with that, I'll wrap it up there. I know we're just about at an hour, so we covered a lot here today, and I'll leave it at that. And Amanda, were there any questions from the audience today?
Hi, David. Yeah, we do have a couple questions here. The first one I have is, will deferred compensation plans be affected by the proposed tax legislation?
Yeah, that's a good question. As many of you may know, there's a proposed tax legislation on the table. We had a version from the House and a version from the Senate. And in those versions, there are some provisions that may actually represent important changes to deferred compensation plans. And actually, there was some language in those bills that affected stock options as well. So we are watching that bill very closely, and we won't know until the final version of the bill comes out. But if you are a participant in any of these plans that we talked about today, you want to be aware, and will be very aware of, any of the final changes that might come out of the new tax bill. So we'll be following that for you.
The next question I have is, if you have multiple stock option grants from different years, do you have to exercise the oldest grants first?
Oh, yes, that's a common question. No, you don't have to exercise your stock options in the order that they were granted. You can just simply exercise based on which options have the most value, or which ones you want to at any given time, but you don't have to do it in order.
And David, I think in respect of everybody's time, I'll just answer this one more, and anything we don't get to, David, will certainly reach out and answer any questions you have that we weren't able to get to today. The question is, if I leave my employer with vested stock options, will I still have until the normal expiration date to exercise these options?
Yes, that is an important point to be aware of. If you do leave an employer with vested stock options, then you would have the ability to exercise them. However, you probably won't have until the normal expiration period, which is usually 10 years after grant. You normally won't have that amount of time. You're usually subject to an accelerated expiration date of, I've seen anywhere from 30, 60, or 90 days after separation from service. So certainly something you want to be aware of if you separate from service with vested options.
Okay, David, I think that's it. So thank you so much for your presentation today. I just want to remind everybody, we're going to be wrapping up our 2017 webinar campaigns next month. It will be on Wednesday, December 27th at noon Eastern Standard Time with Jamie Upson, and he'll be going over strategic income tax planning. So make sure that you visit our website at www.stonehearthcapital.com to sign up for that, and also keep a lookout on our 2018 webinars that will be posting shortly in the next couple of weeks. And David, thank you so much for joining us today.
Okay, thank you, everyone.
All right, take care.